So today we're talking about cash flow and understanding your business finances. This is kind of a snippet of our Stepping into Business program. We do talk about this in one of our weeks of stepping, which does start this week and has registration still available for those of you who are interested in it. That's our 6-week program where we do 1 week on marketing, 1 week on market research, 1 week on financials, 1 on operations. So this is kind of a snapshot of that, but we're going to kind of dive down right into the cash flow part of it. So we're not going to talk about pricing as much. I'm just going to kind of jump over pricing, jump over what gross margins are a little bit. We'll kind of go, it'll get brought up as we talk about cash flow, but they're both things that if you aren't sure about, I do recommend taking that bigger program. Or if you're just not sure and have some questions, feel free to ask me. I'm happy to talk about those things at the end of this session. So when we're talking about cash flow, we want to think about how, this is a quote from Richard Branson, never take your eyes off the cash flow because it's the lifeblood of your business. If you don't know what your cash flow is like or what it's doing in your business, it's really hard to make informed decisions. And we want to make sure that at the very beginning of anything, you're able to make informed decisions. This is before, even if you're not making a high income, even if you're just barely in the black, we'd like you to know what that means by being barely in the black and not just go, oh yeah, I'm good. So today we're focusing on the idea of what a cash flow is. So a cash flow is everything that will come in and out monetarily of your business. Everything. That is from the smallest purchase of a pen to supplies, to every sale that you might do, to things that you might end up writing off. So if you have product that has gotten damaged, how are you dealing with it? That's out. We want to think of all those things. So that's everything from like equity and loans. Are you taking a loan? Are you taking a line of credits? Did you borrow money from somebody? Did you take personal finances to put into your business? Payables, anything that you're going to spend money on, any kind of inventory, how that all looks, as well as receivables. How are you getting it in, and how that all covers with your overhead. And we need to remember our overhead because at the end of the day, we still need to pay our bills. If your ins and outs are almost equal, then that's great. But if you haven't considered your hydro, your rent, your heat, as well as the cost of the products or services you're selling, then you're going to have some problems. And that's usually where we kind of run into issues. So we're going to dive pretty quickly into a cash flow. So we want to talk about why. The big why is always like, what are the purposes of doing this? And I've had a lot of people go, I hate money. No, we can't hate money if you're doing financials, if you're going to business for yourself, but I hate accounting is what I get a lot of. I hate bookkeeping. It's hard. It's stressful. I don't understand it. And yes, it can be stressful and difficult, and you don't have to do it. I'm a big believer in finding the people who know how to do the things that you're not comfortable with doing. So if your first thing is finding a bookkeeper in your business to help you with the bookkeeping, if your first thing is making sure that somebody that you've got your accountants in place, those are all okay. But if we can't pay them, then we run into problems. So and if we don't understand what they're giving us, if they give us all our numbers at the end of the day and you're looking at it and go like, okay, we have numbers, that's great. Then we're not really knowing what we're doing. We're not making informed decisions. We have no way of seeing what early warning indicators are, seeing if like maybe we're not following the trends. Maybe our customers aren't buying the way, maybe buying trends have changed. We need to make sure we're meeting required commitments. Maybe we're purchasing our wholesale products or services in a format that we have a 30, 60, 90-day payable. Well, we have to make sure we have that income in those 30, 60, or 90 days. If somebody else is buying wholesale from us, maybe they want to pay 30, 60, 90 days. We want to make sure that we have enough money in our accounts to cover our bills while we're waiting for that first paycheck from them. We also want to be able to plan for purchases and expansions. If we're looking at doing marketing, we pre-front marketing. Marketing, you usually start 3 to 6 months planning and buying, whether it's the resources, the tools, if you're getting printed items, if you're dealing with somebody third party who's helping you design, those all come 3 to 6 months before the purchases and that marketing goes out. So we need to make sure that we have that float, that overhead to cover that marketing planning before it's actually going to start seeing income come in from it being activated. We also need to make sure that we know what money is needed. What do we need for our hydro to stay on? For our insurance to stay good? Maybe we need to hire a part-time staff so that you have enough time to work in the business as well. But what do we need to make sure that we're covering all their expenses? The government will take their cuts throughout all parts of your business. We need to make sure that we know what that looks like. We also want to sufficiently track our inventory. If we are buying a lot of product to sell product, we need to know when those buying and selling cycles happen, because we don't want to buy when we're at a really high low. What we tend to do is, depending on the cycle, sometimes you're buying 6 to 8 months before the product is showing up. If you are in the gift market, gift shows, if you ever go to the big gift shows in Toronto, this winter gift show is in February, March area. The home and gift show in February, March is people buying products to sell in September, October, November, December. They're preparing their sales. So they already need to know roughly what their purchasing patterns are going to be like and what their income at the base level should look like. So these are things that you're going to want to track. And it also gives us a chance to really review when we're good for hiring more staff in, or hiring that accountant or that bookkeeper, or bringing in third-party companies who might take over your social media, take over the things that you don't want to do. This all is accumulated in a cash flow. A cash flow is going to be our main source of understanding where all those ins and outs come from. And we really need to understand those ins are more than just the income you're making from your product. Those can be loans. The in of the loan or the in of the investment, those cash ins are monies that are coming into your business from some source: cash reserves, sales sources, accounts receivable, credits. But we want to make sure that if you've also put money into your business as an owner, that you're taking that into account. That is something that most owners don't always think about. But if you ever hit a point where you're buying out a partner or you're wanting to sell your company, those are things that you want to know that you've invested into the company to get it started, that based on your shares, certain percentage of whatever, so much money is your initial float that you've put in as investment. So do have that marked down somewhere. So when we're talking about ins and outs, we're also talking about the outs of things like what is my cost of sales? Is my cost fixed or variable? These are things that we're going to want to check on. I'm going to show you a cash flow in a few seconds, and we're going to sit there for a while and talk about the actual flow. But these are things that I like you to have in the back of your head. What are the costs of an advertising plan? Again, we talked about how marketing takes 3 to 6 months of planning ahead of when you're actually going to launch it. So we need to figure out what those plans cost ahead of time so that we can plan for those. This gives you a chance that if we know our ins and outs, we know our high income time of the year is November, December, we might want to plan our spring marketing print off, or even if we have a big thing around Easter, or for next big summer one is summer, we might want to plan that big purchase as of December, so we have set aside those finances. We might, if we need a new sign, we might want to have that start understanding. So we want to plan pretty far ahead for some of these things. We need to also think about payment options and terms when we're thinking about our cash flow. Do we have payment options and terms? I talked about 30, 60, and 90-day terms. As small businesses, on average, most of you will not have terms set in place for your customers. The odd wholesaler will, but most people don't. Until you hit a certain income level, you try to hold off on terms. The most that you might have in terms is that you have an upfront payment of so much if you're in a service-based business where you're like, okay, this is my down payment, this payment number 2 once we hit this certain milestone. This is the final payment before I submit or give you all the final documentation. Terms means that you are sitting on money that you don't have. And we would prefer money in your bank account versus money in somebody else's bank account. So I don't really advise very early stage businesses or small businesses to look into terms unless it's from a supplier. If you're asking for terms from a supplier, they're usually a larger scale business. You might not be able to get them right away. But I like people to start thinking about early on in their business about making sure you build that connection from your suppliers. The reason why is that most suppliers have multiple levels of wholesale pricing. So if you are a product-based business, there is a good chance that your supplier has multiple levels of wholesale pricing. And if you've just started getting in with them, you are probably getting their highest cost level of wholesale pricing. That means they probably have a little bit of more wiggle room, especially if they're a larger entity. So how you get those better prices will be things like building up relationships, making sure your payments are on time, making sure that you are in good standing with them. It might take a few years, but if you don't keep those lines of communications open and those lines of communications open for negotiations, you'll never get those better pricing. So it's something that you'll want to keep in the back of your head. That after you get in with them, maybe in a year or two, once you've shown that you're good at paying your bills regularly, maybe you can ask for terms or better wholesale pricing or higher discount rates based on how much you're purchasing. When we're thinking also about cash out, we want to consider fee schedules. Do you have things like bank fees, loan payments, stuff like that? Also payments. Are you accepting credit card, debit? Those all come with a fee associated with them. How are you covering those fees? Are those rolled into your costing and your pricing of your products? Do you charging customers on top of it? Most people don't charge a customer on top after the initial pricing. So when you're talking about pricing, I think that's something that you should really consider about what those fees would look like for using debit, credit, all those things, so that you roll those into your prices early on. We also want to consider anything that you might have to pay out just as being part of business. That's your registration, that's taxes, member business registration. If you're just a sole proprietor, only lasts for 5 years and they don't send you a reminder. So you have to make sure you make a note of when that 5 years is up, or else you could get fined. They won't remind you, but they will definitely tell you that you don't have it. And make you pay appropriately. And that really sucks. We don't want you to have those things come in place. So whenever you do register your business, make sure you put down that on your calendar, an auto reminder on Google Calendar in 5 years that you need to go and double check that your business is registered and re-register for your 5-year mark. If you're incorporated, it's a lot easier. Your accountant and lawyers will have all that in place. It's a lot easier to manage. You're paying somebody again to help you keep that up. If you incorporate it on your own, do make sure you review what your incorporation documents require for business registrations and yearly fees and all those kind of stuff. Vendor permits also often have a fee associated with it. Are you planning on going to any kind of shows, trade shows, things like that as well? Sometimes there's additional costs for insurances associated with those. We want to consider all of our cash outs, all of it. We don't want to ever have something like, oh, well, that's just a small expense, because those small $2, $5, $10 expenses will add up. You'd be surprised. There's a reason that online app microtransactions are so popular and so profitable, because people don't mind spending $2 here, $2 there, because they don't realize that they spent $20 that week. We want to make sure that we're keeping account of all those little expenditures, okay? All those professional fees. So this is a very basic cash statement. I'll give you a second to take a look at it, and then we'll break it down. I tend to sit on this page the longest because I really want you to understand that it's not that complicated. It looks complicated because there's a lot of numbers there, but really it's not that hard to navigate. A cash statement has our monthly setup at the top. You see February, March, April, May, June, July, August, September. This means their startup was probably January. They are running either a sole proprietorship or partnership, very likely because they have a January to December year end. If they're incorporated, they get to choose their year end, so sometimes it changes. If you are incorporated, I recommend starting off your cash flow with the first month of your fiscal year. So if your first month of your fiscal year is March, April, May, June, July, and across to the following. So that your next year starts March again, so following February. When we're talking about cash flow, we want to break it down of ins versus outs. All our ins are at the top. All our ins are our sales, any loans, any owner investments, and any other form of income that might be going into your business. If you get a grant, that's an in. If you get assistance from the government, that's an in. These are all things that any kind of income that is coming to you that you put into your bank account, it sounds pretty simple, but we'll spell it out, is a cash in. In our cash ins, we can see our sales on the top. Those are our sales totals per month. She had, obviously, you can see in our startup, that first sales startup sheet. Like I said, I usually like a January and a startup as its own line. Startup gives you a chance to then pull out your last months of your previous fiscal year to kind of see where you're ending on, to give you a starting point. But it also is, if you're brand new to business, these are the costs that you have put in place and sales that you've put in place before you've opened your doors. So if you were starting a Kickstarter, you would have your startup expenses, all those initial fees of like pre-sales under startup. We have our incomes across the top there. We've made $9,000 the first month. This is actually pretty good incomes for early stage beginning. And you can see it says total cash in. That is the sum of all the dollars above it. Pretty straightforward so far. Our cash outs is the next bottom stage. Hold on, so I gotta move things off my screen so I can see everything. Our cash out materials is all those expenses of things that we're selling. So if we're in a retail store, it would be the retail products. If we're in a service-based industry, if we had to buy materials to make our things work, or if we're buying paper that we're printing on for our customers, stuff like that. Anything that would be a material cost associated with your business for your customers or to make your products will go under that. Wages are your wages, but are not you. You as an owner do not take out wages unless you are an incorporated business and you are set up to take out a salary or an hourly rate. As a sole proprietor or a partnership, you would be drawings, which you would see down lower. Your income is drawings. Wages are any employee you have. Okay. Automobile expenses. As a sole proprietor or partnership, you would track automobile expenses based on travel. So that's in and out. If you look at the tax forms that they would like you to do, tracking your automobile expenses will not be based on a rate of 50% per kilometer, because your car's repairs and all that will have a percentage based on usage. So when you're dealing with automobile expenses, you might, as a sole proprietor, want to break that down further and have a separate document, a separate page in your Excel sheet that says automobile with all your travel have a log of I've gone here, I've gone there, I've gone here, I've gone there. Here's all my expenses for repairs. Here's all my expenses for gas. Because at the end of the year, when you're dealing with taxes, it's a percentage. So if you used your automobile 40% for personal expenses and the other 60% for business expenses, you would get to claim 60% of your automobile's everything towards your end of the year taxes. Does that make sense to those of you who are in the room? So automobile expenses will not be tracked based on just kilometers unless you're incorporated. If you're incorporated, then you would probably, then unless your automobile is part of the business, there are different ways to track it, and usually it's by mileage. But if for sole proprietorships and partnerships, they want you to track it as a percentage of usage because they know that you're probably using it for personal use as well as business use. So that means if you haven't already, highly recommend, whether it's an app or a little notebook that you keep in your truck or car, having a log. And that just tracks, I've traveled from here to here, personal, here to here, business, here to here, personal, here to here, business, and keep those kilometer logs down. You can get apps for that will help you tracking. You just punch it in and it has their GPS and it'll give you the kilometers. Just make sure that you download or screenshot your apps regularly. If that app stops being supported or is no longer used or just gets shut down for some reason, you will lose all your documentation and the CRA requires you to keep that for 7 years. So as much as we trust technology, there's a certain amount of thing with apps that I would highly recommend downloading those things so that you have them. For fixtures, that's anything inside your business. So you usually send it upfront most of those expenses, which is why they're in the front line, but they can be, you could buy a new display at some point during the year. Equipment, again, things that make things within your business. Some people you put equipment, some people put like electronic equipment where there's computer printers, things like that. They have a depreciation value that you can put towards your business as well. Loan payments. So as we're going down this, you'll see that the loan payments is where I like to really kind of dive in. Loan payments has 2 lines. The reason it has 2 lines is we're looking at 2 different things. When we're talking about cash out, there are fixed expenses. Those are expenses you have to pay no matter what. Rent, hydro, your phone bill, your loan interest payments. But there are variable expenses, your materials, your wage costs, and your any loan payments above and beyond the bare minimum that the bank asks you to pay. The reason we separate those out is if you are having a hard month, you might regularly put on your loan $500, but $120 or $113 in this case is all that you actually need. That means that that difference is going towards your principal instead of just going towards the interest, which is great. We want to bring that principal down. But at the same time, that means that that difference is if you're having a slow month, you don't have to pay as much. If you're like, I'm really tight because it's Christmas, or I'm really tight because we've just had our Christmas rush and now we're in our lull, well, then maybe you don't put as big of a payment towards your loan payments and you only pay that interest that 1 month. So these are things that we need to consider as business owners, is where those variable expenses are. Because if we have tight months, the variable expenses are where we're going to have to cut. As we document this out, you'll see that there are things like repairs and maintenance. So most of this, like I said, variables, fixed, it's pretty straightforward. But we have a line for everything. If you're not sure where it goes, put it on a line item it out, even if it's only once a year that you pay it. The reason we want to line item it out is it's more likely for you and your accountant and your bookkeeper to find the right place for it at the end of the year for your taxes. And it also gives you a chance to know where your money is going. Because as we look through this, we see our cash is in totaled at the top there. Under our cash is out, we also have a total of cashes out at the bottom. So our ins versus out give us our net cash. That is a simple conversion of the cash is in minus the cash is out. So the 42,000 minus 29,000 is that 13,000. Okay. And as we go down, 9,932 minus 9,591 is still a positive 341. As we go across, we see that December we're in the red. $14,073 is smaller than $14,481. That means that they technically lost money that month. Okay. They're the red. They spent more out than they made in. Our cumulative is our accounting balance across our board. So that is our cumulative total plus or minus, depending on if it's a negative. So plus our net cash from our current month. So in February, our total was 341. We now add that to our 13,051, and that gives us 13,392. Does that make sense? So that bounces all the way across. So when we see our December, we already had $17,311 in our bank account. We had a negative of $402 that came out. So our total for our end of the year is 16,903. So what we're looking at here is that we still have money in our bank account. Okay. But we were in the red that month. If we are finding that we have low, like the month before was $92, from the way this income statement looks, I would say that this company is probably a spring summer based business. They are probably, maybe they're doing lawn maintenance or lawn care. Maybe they're doing some kind of service base that's heavily in the summer, because their main income has come through the spring summer months and they've died off in the winter. Maybe they're doing a little bit of snow removal and that's about it for their income there. Hopefully that picks up for their following year. When we're balancing our cash flows, what we do is that final column on the far right is our sums across. Okay, so we see, like, if we look at the wages line, the sum of everything in there will be that $7,035. And then the sum of that cash in versus cash out will be our net cash, our net total, which is the sum of those sums, is 16,903. To balance our books, that 16,903 needs to be the same number as the cumulative balance that we're at. So whatever month we're in, so being this is right to December, that December number has to match that net number. So you see that 16,903 are the same numbers. If they are not, there is something wrong with the calculation. So that means we have to go back through our cash flow and see where our errors are. When we used to do these manually, and yes, I have done them manually. I used to do my mother's ledgers when I was in high school. When we used to do these manually, you would see more errors because you would sit there with a calculator and a ticker tape and you would type in manually all your numbers and you'd write your numbers in your ledger book. With Excel and Google Sheets and and QuickBooks and all these online services, bigger services, you should have less errors because the calculations, as long as your lines are highlighted appropriately and you're summing up the right lines, should automatically sum appropriately. So your errors should be a lot less in the way of making sure that they balance. Where your errors will come into place is if you entered in the wrong numbers. So that means that when you're dealing with your cash flow, we want it as accurately as possible because this will affect everything in our business. I highly recommend going through and reviewing your numbers mid-month as well. I put them all in for my January numbers. I wait till the middle of February. I review that I put my January numbers in right. This gives you a couple of days or a couple of weeks where you're not like in the middle of everything, that you can go back and review that your numbers are accurate, and you can kind of see where your numbers are landing then mid-February, so that you kind of keep on track of where your numbers are going. As a business owner, you should set aside time to work in your business a couple of hours at least twice every other week. So I would say Monday, if it's your slow day, book off an hour or two to just review your numbers every other week or so. Make sure those numbers from last month are accurate, and make sure you know where you are roughly in the middle of this month, and then keep that going. Because at the end of every month, when you're putting all your numbers together, it can be pretty stressful. So if you work on it as you go through and make sure you're as accurate as possible, it's less stressful. And don't be one of those people who just throws all your receipts into a drawer and you don't look at it till tax time. I know there's lots of us out there that have done that. I've done it. I'll admit it. I've done it in the past when I run small little businesses, but that's what happens to a lot of people when they don't know what's going out of their business. And what happens is we've spent more sometimes in all those little receipts than we realize we have, and we're actually been running in the red for months. And I want you to know ahead of time where that money's going, as this will be the best tool for helping you to develop and grow your business. Like, I can give you marketing tips left, right, and center. I can give you how to talk to your customers, sales resources, you name it. But if you don't know where your numbers are going or what your numbers mean, it's going to be very hard for you to make appropriate adjustments and well-informed decisions moving your business forward. Okay? So as you can see, those were pretty easy to make a cash flow. This is pretty straightforward. You can make it in Excel. It doesn't need to be fancy. It's not rocket surgery. What we need to think about when we're talking about our expenses are we want to really hone down that idea of fixed and variable expenses. That's something that you want to sit with and figure out, because some things are fixed and variable depending on the industry. You might decide that maybe your hydro does go down a little in the summers because maybe you can have all your windows open and you don't need as much light or things like that. There's going to be slightly variable, but at the end of the day, your fixed expenses will always be your rent, your general bill payments, your internet, anything to do with that general ins and outs. Yep, I have a template. I actually have a larger sales document sheet that I'll send you. I send it to everybody in our stepping program. It's a multi-page Excel sheet that will even help you with figuring out sales forecasting, and it gives you a good chance to put down like what are all your different products and what are they cost and how much do you think you'll sell each month, and then you can what are your actual sales each month for those products, stuff like that. So it gives you a chance to look through that. I'm happy for if you just want to work on that Excel sheet later on, and if you want to send it to me so I can look at it. I don't mind taking a few minutes and reviewing it with you and saying one-on-one, we can book appointments, because I know this is hard sometimes if you don't have that math brain, and not everybody who gets into business are business people at the core. Most of them are entrepreneurs who know their business very, very well, and that is okay. You can be really good at what you know, but this is something that if you want to grow and develop your business and you don't want to be living month to month, we're going to want to learn what these numbers mean. So we're talking about fixed expenses. Those are anything that you can't change. When we're talking about variable expenses, those are the things that you can change. So that means if you're having a slow month, maybe you cut down your staffing hours. Maybe you don't take as big of a dividend out that much. Maybe you reduce your marketing costs. Most of the time, people need to increase their marketing if they're slow, but that's still something that you might want to have forefronted on a month that you had a bigger income so that you're prepared. You might reduce general office expenses. Maybe don't buy as many pens that month and try and make the things you have last longer. Materials costs are one of those things that people forget about. Yes, you have to create, especially if you're a product-based business, that you're building things or making things, but do an inventory. Maybe there are things that have been sitting on your shelf for 6 months or a year, and in those slow months, we can figure out what to do with them. Or maybe we use them up, we put a marker in our products, in our thing saying, okay, we need 2 months to order this thing. I should have enough for this many products. How about when I hit this level, I reorder instead of just reordering any time that I'm out of a box and not having so much on my shelf until it's getting to the busier seasons. We want to also think about what products are just sitting on our shelves when we're hitting low months, because those variable expenses we want to see on those low months, you'll want to see more outs. And that's when people try to move products with sales or other kinds of resources. So we got to think about those kind of things. Being a business owner is being creative on how to save, spend, and sell. Okay. Jack Welsh is an independent business owner. He also is a chemical engineer, but too often we measure everything and understand nothing. 3 of most important things we need to measure in our business are customer satisfaction, because that means we're going to get more sales. Employee satisfaction, because that means you're going to sell well. And cash flow. So if you're growing customer satisfaction, your global market share should grow too. If your employees are satisfied, your productivity, quality, pride, creativity should increase. But your cash flow is your pulse. That's the key vitality. That's that little statement that's us plugging into our monitors and making sure that we're still alive. And if we don't know that, we're not going to be able to live. Within our cash flow, there are a few things that we're going to pull out. From our cash flow, we pull out our income statement. An income statement is all of our revenue and expenses. So this does not include loans, large-scale purchases like equipment, things that have value to them that we've paid money for or that we have a loan for, but are just sitting. These are all the things that will change monthly. So wages, interest, bank fees. So to understand our income statement, and this is one of the ones that I feel that people really need to understand, is we're going to look at your sales, all the sales, the things that you made money on, the cost of goods. So that's that materials cost. That's the cost that we had to make the products. The sales versus cost gives us our gross profit. Okay, that gives us how much money we put in our pocket after the cost of making our things. From that, we take out all our operating expenses. Those are our wages, our loan interest. That's not our loan principals. That's not our extra payments that we're putting onto our loan. That's just our loan interest, any advertising costs, any banking fees, anything that we put into in that month that we paid out that wasn't a large purchase, like a car or a computer. Okay, those will go on a different statement. From that, we say, okay, our gross profit minus those totals will give us our net profit. That's how much we made in our pocket. And now we pull out our drawings. Our drawings is how much we pay ourselves. So from this statement, our gross profit minus our net total expenses gave us a net profit of $3,000 for that year. This is based on that cash flow I showed you earlier. The drawings was $15,000. So they are technically in the red. The reason they were able to survive is they had a $20,000 increase. They put $20,000 of their own money, plus they had a bank loan, which are not shown on here. That's how they're able to survive. But technically, their business barely made money their first year. Things that I like you to be aware of. One, they probably shouldn't have taken drawings out. They weren't actually making money, but you do have to survive. So that's something that you have to be prepared for. Two, if we look at the top part of this document, that sales, cost of goods sold, and gross profit. Our cost of goods sold versus our sales gives us an 86% profit off of our profit margin. So our gross profit margin is only 13%. That is a really low gross profit margin. Their margin is way too low. You should aim for a gross profit margin of between 30 and 60%, depending on your business. Every business and industry has different profit margins. When you're talking about food-based businesses, they tend to be on the lower scale. You can't really play with them too much. Certain product-based businesses, depends on where you get. So there are one of two problems or a combination of the problems going on with this business. They are either spending too much on the stuff they're using to make their products. So their cost of goods is too high. Maybe they are a crafting-based business and they're buying all their base product from someplace like Michael's. Michael's is really high cost. They're not getting a really good price. They're paying consumer level costs for that base product that they are then rolling into their actual product development. Maybe they're not selling high enough. Maybe their pricing is off. Maybe they're selling their products at $40 a product when really they should have been at closer to $60, $80, $100 a product. Or maybe it's a combination of the two. Maybe they haven't done their work to find a good wholesale price. So they need to find suppliers that'll give them a better wholesaling price. That means that, yeah, maybe they need to purchase in a larger bulk to get a better pricing. When you're dealing with wholesalers, they will sometimes let you pre-agree to a larger wholesale yearly amount, but only ship you smaller quantities of that. A lot of packaging will let you sign up to get that price break at that 10,000 packages mark, but then we'll let you bring in 5,000 at a time twice a year. So you don't have to store in your warehouse all the 10,000 packages. There are options, but you need to talk to your providers. You need to talk to your providers for that stuff. Figure out what works for you, what works for your providers. It might mean you have to find a different provider for those things. There is a reason that a lot of small business starts off by buying from international providers because they can buy it at a lower rate. And then later on, increasing your product sales and increasing your purchase rates so that you can buy more locally. Anything locally created when you're talking about manufacturing is going to have a slightly higher cost because our wages are higher. Our requirements to government expenses are higher, and that is okay. But you need to understand that and then put that back into your pricing margins. And then again, maybe you're not pricing appropriately and you need to do a review of your pricing. We've seen businesses come through who haven't taken into account all the material costs they're using. So they assume that they're actually pricing accordingly, but then whenever they actually break down the material costs by a per unit level, they're actually losing money. They're selling a t-shirt for $10 a t-shirt, but they're actually buying all the products to make and design that t-shirt at $12 a t-shirt. So every time somebody buys something, they're giving them an extra $2 worth of product that they're not, so they're bringing themselves in the red regularly. These happen. So these are things that you want to review. If your profit margin is in that 30 to 60%, but you're still finding out that you're not actually making a good enough income to pay your bills, this is when we need to start looking at all those other operating expenses. Maybe your wages are too high. Maybe you shouldn't take as high a dividend out or drawing out as you are. Maybe you can't afford the rent on the location you are. You're not making enough sales to cover your rent and you need to look for a cheaper location. Maybe you need to up your production. Maybe you're selling out regularly. Either way, we need to keep an eye on those statements because this will give us a chance to make decisions that will affect our business and let us know whether or not we are ending up in a net profit loss statement that is really low or at a decent rate. The other part of your cash flow will go to your balance sheet. This is your assets versus your liabilities. So this is where we see cash on hand and inventory, and any of our larger purchases. So that's equipment, fixtures, automobile expenses. You will have computers, things like that on here. These are things that will slowly depreciate. So as well. So on your taxes, you'll see things that can depreciate in a percentage because you have to pull them over a few years. If you buy a car through your business, you can't claim that full expense of that car in that year. You kind of have to break it out over multiple years. That's the same thing. Your balance sheet should balance how much you have in cash and assets should balance how much equity and liabilities you have. So if you have an automobile and you've had a loan statement for the same amount, as you pay off your loan, your car will depreciate. Hopefully they're balancing. So we want to keep an eye on those. A balance sheet is a snapshot. So a balance sheet is not always as, you can look at it in 6 weeks and it might not be the same, obviously. But so you'll want to snapshot that fairly regularly, maybe even once a month, to see where you are with your cash versus your inventory versus your fixed expenses, fixed liabilities. So these are assets. Things that you can sell to make you money. Okay, so all assets are things you sell. Your car that's in your business, any equipment in your business, and the things that you have to pay off. Okay, or you've put into your business. When we're talking about bricks and mortars and home base, there's some things that we got to consider. When we're doing a home-based business, we want to also track our personal and business expenses because at the end of the day, when you put in your expenses, you will only be able to claim a percentage of your hydro, a percentage of your heat of your home office. So the only way you'll know what those percentages are is if you track all your personal. So you need to have an idea of what all your hydro is for the year, all those kinds of things, all your mortgage statements, all your property taxes, all your insurances, because when you're dealing with your taxes, they will ask you, what is the percentage of your property that you use for business purposes? Do you have a home office? Is that 20%? Is that 6% of that overall space? You will measure your house. You have 100,000 square foot of house. If 20 square feet of it is your office, that percentage versus the 100,000 is how much you take off your hydro, your heat, and everything towards your business expense. So we need to understand what that percentage of space is, as well as how much we're tracking for our overall personal expenses. So again, I talked about for your car payments, if you've done repairs, everything should be tracked. I know we hate doing this. Especially if you're smaller in business and you're not sure if you're in the black at all, it's more daunting. There's if you talk to financial advisors, they'll tell you the people who don't open the bills are usually the people who don't have any money. If you're not looking at your bills and your mail that comes in, if you're not looking at your bank account statement, it's usually because you know that it's not good and you just don't want to be honest with yourself. As a business owner, we can't allow that to continue to happen. We have to actually be honest with ourselves and open those statements. Okay? So the only way we're going to be able to be honest with ourselves is to start tracking. And it doesn't have to be difficult. Again, once a month, twice a month, sit down, put those into statements. If you have a partner, whether it's a business partner or a family partner that's dealing with your expenses, it's worth having financial conversations once a month. Say, okay, you know what, we paid all our bills. Let's sit down once a month and talk about our financials. It's daunting. If you've come, like I've come from a family with very low income levels, and it's something that my partner and I do. And the first few times, I will tell you, if you are an emotional person, you might feel like it's an attack and you might cry. We all do it. It's okay. As you do it more regularly, you won't find it as difficult. And it's helping you both be honest about where you are in your expenses personally and where you are in your expenses financially for your business. And this might be a good thing because it might hit you a point where you're like, I am working this many hours on this in my business. Maybe I can do this full time. And that happens. But if you haven't ever reviewed this, your expenses, if you don't review your personal expenses on a regular and you don't review your business ins and outs, you might not ever notice that you're spending more money on gas going to your day job and trying to eat out than you are actually making in. Or maybe you're spending more on daycare than you are if you just stayed home. Like there are things that you can do in your personal finances, and this isn't me telling you how to do your finances because I am definitely not a financial advisor. But if you don't know what it's doing, you can't make those decisions. In a brick and mortar, it's a little different. And I know we're coming close to time, but I'm going to keep talking. And those of you who have to leave, feel free to leave, but I feel this is important. In a brick and mortar, it's a little easier to separate your business finances than your personal. As a personal, I still say you should have a separate account, even if it's just a separate checking account to start off with and later on get a business account. But a separate account you should still have for your business. And a brick and mortar, because you have a physical space, it's a lot easier not to take those ins and outs home. It's a lot easier to separate those out. But you should still track your personal expenses, and you have to remember that the money in your business is not your personal piggy bank. I know most of you will be like, well, of course it's not. But you will be surprised at how many business owners I have met who will be like, oh, I need something. And they take it out of their cash. Like, oh, I'm just going to take $10 out of here and go buy myself something for my home. That needs to be recorded as a dividend. That needs to be recorded somewhere so that you can say that in the month of September, you took these much out as personal expenses. There are many businesses, including I had my family owned an art studio. My grandmother would do this all the time. It took us getting her out of the business for her to stop just taking supplies right off the shelf because she decided she needed that new thing. And we're like, no. When we buy supplies for the store, they have to stay in the store. Or you have to make note of it so that they can go out onto as part of your expenses. So making sure that they stay separated is important. When we're at the end of the day, our main goal is to be able to analyze our cash flow. So again, we want to analyze that 80-20 rule, that 80% of your business comes from 20% of your customers. So we want to make sure that we're knowing when those 20% of customers are actually purchasing and what they're purchasing. So again, when we're talking about that line item for sales, you're probably going to have a breakdown on a separate sheet of what kind of products are selling each month that you're going to want to look at. Because this gives you an idea of like, maybe if I have 6 products in my store and these 3 products are selling like hotcakes, Maybe I don't buy that seventh product. Maybe these two products are selling. Maybe I buy extras of those. I love sweaters, but my customers aren't buying sweaters. Maybe I don't bring as many sweaters in. I love yarn if I'm a yarn store of certain quality, but I only sell 3 of those a month. Maybe I need to bring in more of that mid-range. That's okay, but we won't know that unless we're tracking those. We need to track things like when bills are due. Use your supplier discounts. Make sure you talk to your suppliers. Review those terms and conditions. Review the terms and conditions as a supplier for your suppliers, as well as if you're a service-based business, you should have terms and conditions for the services you're providing. If you don't, you need to put those in place. Things like return policies, things like agreements. I have done marketing and market research for people before. I have stages that you never go back to. I charge hourly. If you've agreed that this is the design I'm suing you and I go to the final stage of finalizing the design, you do not get to go back and completely change the design on me in that last stage. Things like that. We want to, again, monitor actual to budget variances. We want to know when our peak months are. The only way we're going to do that is tracking, because sometimes the peak months aren't the months you think they're going to be. Maybe you are in an industry that is heavily focused on travel, and it's before that Christmas rush and that summer rush because everybody wants to go on vacation. A lot of the bathing suit businesses do that. They'll see a peak for bathing suit sales in like November, December for all the people who want to travel in, and sometimes even January for all those people who like to travel on cruises in February, March, April. So we want to again, monitor inventory levels, watch those receivables. So not too far over time, 2 minutes, but what I'm going to do is I will stop this recording. So for those of you who are watching it on the recording, you can let me know. Feel free to email me at success@guelphbusiness.com if you need any help with if you're still not understanding what the cash ins and outs mean in the general cash flow. Feel free to email us. Either me or one of our advisors would be happy to sit down with you and talk about it. If you aren't watching online, if you're in this room, please stick around and we can have more of a conversation.